Greetings and welcome everyone. Thank you for joining us today to discuss the Intellect Design Arena Limited financial result for the first quarter of the fiscal year 2022-23 ending 30th June 2022. The investor presentation and the press release has been sent to all of you and is also available on our website. Our leadership team is present on the call to discuss the result. We have with us today Mr. Arun Jain, Chairman and Managing Director, Mr. Prabal Basurai, Advisor to the Chairman and Director on the Corporate Board, Mr. Manish Makan, CEO of IGTV, Mr. Rajesh Saxena, CEO of IGCV, Mr. TV Sinha, CEO of IRTN, Mr. Venkat Saranu, CFO, Mr. Andrew England, Full-Time Director. Besides, some other senior members of the Intellect management team are present on the call. Mr. Arun Jain will brief you on the result, and this will be followed by Q&A. This will be replied by the senior members of the management team. Once the Q&A starts, you can ask the question by clicking on the raise your hand, and we would unmute you so everyone will be able to listen to you. One safe harbor. I would like to remind you that anything which we say, which refers to our outlook for the future, is a forward-looking statement. This must be read in conjunction with the risks the company faces. With this, I request Arun to give his briefing. Over to you, Arun.
Good evening, everyone. Thank you for joining into this platform for investors where we are interacting with you on quarterly basis. Every 90 days, we're regularly participating and building the institution called Intellect. So let me take you through the entire journey, what changed in this quarter. Some of you would have been the new participant over here, so for whom I would like to share somewhat is quick overview of the company. As you know, company has a depth and edge are the two keywords in our journey, which build next generation open finance composable solution. So that's where the story is there, which is very, very important story to work on. We won 6 awards, number 1 in retail banking, number 1 in transaction banking, insurtech, lending, with a base of product breadth and regional leader. So this itself is a starting point. Safe harbor statements are to ensure that this is the presentation. So maybe Parveen Malik, you want to read it, or it's okay to go ahead and skip it?
We can go ahead, Arun.
Okay. In this quarter, we look at it and we spend a lot of time in our design for digital, which was our byline. And when we are talking to the customer and helping them in digital transformation and employees and everyone, the common thread came out that we are helping to live their dream in their journey, helping them to make more profit, helping them to having more customer satisfaction, and then with the consistency of purpose. So we picked up our old live your dream as a byline from design for digital. Our purpose as an organization, and during the technology day, we said we provide large enterprise grade composable and contextual solutions, driving higher business growth, reducing cost and risk on sustainable basis. This is the purpose of organization. The difference Intellect versus any fintech is we are in large enterprise grade, very high volume, make it composable, contextual, driving higher business growth for our customers, and reducing cost and risk using AI machine learnings on sustainable basis. We are ranked number 1 in 6 categories, 25 years of experience, 97 countries served, 10 products. So instead of 12 products, we moved the 2 products to the platforms. 6 platforms are becoming more rich, and 4 technologies. Very good board of directors, good strategic advisory board from all over the world, the good bankers from Europe, from Americas, from India and Middle East. This is our evolution from technology stack. When we added data model, we created products. Since data model and products are based on open APIs and microservices, we bundled into cloud and created platforms. And then we start doing third-party participant and plus fintech, it becomes marketplace. So this is the 4 vocabulary we are sharing here. I'll be taking you the platform and product because if you need to know more about our deck, you should go to December 7th Technology Day presentation, which is available in the website to understand the whole technology story of the company and how quarter on quarter we are moving from December 7th from product to platform. So looking at Q1 financial highlights, this quarter we grown healthily, 33% of the growth against 20%, which we believe and calibrated. In dollar terms also, it's a 27% growth to $70 million in just last 4 quarters. Then our EBITDA has moved 17% in spite of the cost and full cost post-COVID has come into system. So it's in line with our journey because our travel cost itself has moved by close to 13 crore is just the travel cost increase beside the talent cost increase. PAT has been reduced because of some of the taxes which have gone up. As we advised last time, it's a full tax regime we are getting into. It's around 26% of the tax, which is being put on our PBT. But the advantage for us is we still have a MAT credit where tax outflow, cash outflow may not be there. So that will be, cash outflow will be maybe 10%, not 26%. Gross margin stands at 55.6%. EBITDA stands at 21.6% and collection is 473 crore. My DSOs are 114 versus 125. So good collection this time. And this quarter, we could able to collect a lot of money from the Indian government also, which was a concern last time for the investors. GEM, we collected close to 100 crore. Then if I look at a revenue distribution platform, I'm calling this, we used to call SaaS cloud revenue. We rebranded as a platform revenue. I'll share what it does it mean on the platform and in my qualitative comments. So as of now, platform revenue moved up by 47%, very healthy revenue. License is minus 3%, 10% is AMC growth, 18% is license linked revenue growth, and annual recurring revenue growth moved up by 28%. 10 wins and 5 platform wins, 11 new digital transformation completed. Now we started giving, this was a request made that last 12 quarter makes a lot of difference. And when we look at it last 12 months, not 12 quarters, last 12 month LTM revenues. So we plotted LTM revenue for you to highlight that quarterly revenue for Intellect will be up and down in various buckets. But when you are looking LTM revenue, that will give you the trend of movement. So LTM revenue moved to by 29% over the last 4 quarters, where our growth is 29% against 20%. At a dollar level, it's a 26%. We moved to $267 million from $212 million. Gross margin stood growth at 31%. EBITDA grew at 26% on LTM basis. PAT grew at 17%. Gross margin on LTM basis is 57.3% and EBITDA is 24.3%. On LTM, my platform revenues grew at heftily 90%, 220 crore to 400 crore, almost doubling our platform revenue on a sustained basis. License is almost flat. We are able to sustain the license. It's not got cannibalized with the platform. We are able to sustain. That was a concern investor raised earlier. AMC grew by 11%. License link revenue crossed 1100 crores, which is a very powerful. By our investment of close to 300 crore, we are able to generate license link revenue of 1100 crore. Our capex to sales ratio is now 15% on investments. Annual recurring revenue is 756 crore, which is grew by 44%, which has got a cloud plus AMC coming together. In the last 4 quarters, 35 wins, 18 platform wins, and go lives, which determine our referencing, which determined by the, how many are there? 54 digital transformation deal for the customer. The sales pipeline is going very healthy now. I think we are now in a position to choose the deals which we want to take it up. We are cross $805 million. That's the capacity what we have to handle as of now. If you need to increase the capacity now for sales and pre-sales. Number of deals, which we call destiny deals, is growing year on year, and that's how the build up is happening. So we were running around $45 million to $60 million bucket. Now, that time the number of destiny deals used to be 30, 35. Now it's 64, and that's what the capacity of the deal is getting created. Average deal size is also increasing. So now average deal size is coming to $6.2 million per average deal value, compared to $5.6 million last year. So on both the dimension, the quality of the deal and number of deals both are increasing over here. That indicates the number of deals more than 50 crore or more than 10 million are moved by almost 60%. From 9 such deals has been pipeline, which is moving to 15 such deals. This is the currency mix, GBP and Euro. This quarter we suffered because of higher 23% exposure of our revenues comes from the GBP and Euro, and those currencies have fallen by 15%. 15 to 18%, these currencies have fallen. So we suffered a loss of $1.5 million because of the currency drop. We have the digital transformation. 11 global financial institutions have transformed their digital journey on Intellect product stack. These are the 5 platform deals which we have won during the quarter, in which we need to highlight a private sector bank in Africa has chosen digital core. So digital core, which is a second product in the, we are top 3 products if you remember: liquidity, DTB, and quantum. And then next set of product is digital core, lending, and payments. So now if you look at first 2 deal win represents the acceleration in the core banking and lending. So if you look at first 3 deals are in that area, and the 4th deal is in the area of Seek and AI machine learning platform. And again, lending platform. So 2 deals lending, 2 deals core, which is showing the momentum moving. This lending and core is moving to leadership quadrant. We have now the 3rd quadrant product for wealth, treasury, and trade, out of which now wealth is emerging, which is moving from 3rd bucket to 2nd bucket. After signing SBI 2 quarters back, now we got a second big deal out of the top 5 private bank has signed up with us for their wealth, and we have a good pipeline within India for the wealth. Quantum is carrying the momentum by winning 2 large deals in the quarter. One is from large bank of Saudi, Central Bank of Saudi, and then central bank, which of the central bank in Africa, which is driving the significant change in Africa. So quantum deals are becoming more pull deals, and we are getting a significant mind share of the market. Important deal is in Canadian bank market and North American market. So both of these deals are interesting deals which I want to highlight. That are North America, I'll take the market story, but Canadian and American market is moving positively in the right direction. The interesting digital transformation we have done. So one of the first element where we do top 5 bank in UAE when CBX retail. This is a space which Backbase used to lead, and we are able to do a kind of a contextual experience by bringing lifestyle banking together using AI, data analytics, agile architecture, code agnostic. It is helping the bank to acquire customer at 3 times faster pace than any other bank. Similarly, we have second bank in Middle East which has gone live with the CBX retail and iTurmeric to define how the branch banking and digital system will work. The third element is North America. This customer has gone live with liquidity. Now, one of the top 3 banks in India is now live with WealthCube. So and so forth. Then we have one of the large bank of Spain. We went live in Argentina and Mexico. So that is a small entry into South America. This will get us some knowledge in South America for next 2-3 years, not immediately. Chile, we have a footprint in South America. Similarly, a large financial institution announced IGCB mobile solution. The state-owned commercial bank in Sri Lanka went live with Capital Alpha. So these are the 11 transformation deal. These are the results you must have seen. So I will skip this slide. Let me run to the qualitative commentary. Because this is a presentation when we are looking at it between last 2 years at the time of COVID and post-COVID Islam, almost 2 years post-COVID, this presentation is happening, where we are making a significant shift. So last 2 years, we were working on a calibrated manner and some more changes. And then December, we made a presentation on technology day 2. We started looking $15 million as the investment buckets. So we are looking for each investment bucket. When we were in July 2020, we were $45 million in revenue. And then we looked at it, how do we move to 60 million in revenue? And it took us 5 quarters to reach to $60 million revenue. From them, and we started in second quarter when I was speaking to you, we said that we started investing for $75 million. Now we have a visibility of $75 million. We are already crossed 70 million in this quarter, and next 2 quarters, definitely $75 million is visible to us. Now at this point of time, we may have to move to the investment of next $15 million bucket of 90 million quarterly run rate. So that's a preparation for the next year for the sustainable growth. We mentioned in May 22, there are 3 additional costs which are going to be there for this quarterly result. First was reinstatement of travel costs post-COVID, tax rate of around 26%, and additional cost for platform and R&D in line. So their third cost was additional cost for platforms. When we are moving to platform, and R&D cost goes up during the early stages of platform build up. So when I come to platform, I'll explain what the platform means and how is the revenue model of platform works. I mentioned about sales pipeline earlier. In technology day 2, we said we have a 4 platform we launched. When we launch on that day, we look at Exponent, underwriting platform in US. We looked at it, Cash Cloud, DTB platform. We looked at it, iCredit 360, and we looked at it, IDC core bank open finance banking platform with 300 APIs. Then we launched a platform called iColumbus.ai in first quarter. In second quarter, we launched Magic Invoice as a platform. There's become 6 platforms. So let me take you through what do you mean by platform and what do you mean by product. Now there are 2 categories of platforms which Intellect has ability to launch. So first kind of platforms are subscription-based platforms. So when we give a platform, we give it in a cloud, the complete infrastructure, complete technology, complete accountability of running the platform, where bank lease out the technology platform from us on a fixed sum, which can vary from $40,000 per month to $100,000 per month. It can go up to $200,000 per month. So this platform leasing will be between $40,000 to $200,000 per month is a kind of a platform which is subscription platform. So if we have a 3 category of businesses, if we say B1, B2, B3, B1 business is my license business, B2 business is my platform business, which is on annual subscription model. And then there's a B3 business, which is based on, which is also a platform where we offer the platform like GEM, and we charge on the transaction basis or percentage of the business basis. So that's based on the volume of the customer, pay per drink kind of a platform, which is a B3 business. So B1, B2, B3 are the 3 possible revenue line which we call license link revenue. All the 3 B1 plus B2 plus B3 become license link revenue, while B1 is not recurring in nature, only AMC is recurring after that. B2 plus B3 plus AMC become my recurring revenues. So these are 2 points we need to explain. What is license link revenue and what is annual recurring revenue? When I mentioned in the beginning, the annual recurring revenues are AMC plus B2, which is the annual subscription license plus transaction license is a, so B2 plus B3 plus AMC is my 3 revenue stream pool into call annual, which is around 741 crore we did this quarter. And license link revenue of 1100 crore we did is, which is direct license plus B2 plus B3 combined together forms my license link revenue, which is 1100 crore. Now, after successful of GEM platform, we are fully in a stage where it's growing quarter on quarter. And last year it grew much faster. It will not grow the same pace as last year it grew, because that is the time when government sale moved from 30,000 crore to 1 lakh crore in a single quarter. So a single year, this will grow now 50%, 60% levels. Now we have picked up Exponent platform, which is based on AI. That is now gaining traction. The revenue is not start building it up. So in a platform business, I need to put up a constant team. So when you set up a platform, it means you're setting up a constant investment. A typical platform investment for building a platform may be close to $5 million per year. That's a typical model. In US, typical platform, when you look at the investment, a lot of fintech companies are coming with a platform. Each platform costs between $5 to $10 million per year on a constant basis on the platform. That's what, when we are building GEM, we are spending that kind of a money on the platform. So that is the axis, which is flat axis. If you look at the graph, an initial period when you get only 2 customers or 3 customers, your cost remains 5 million, while your expense will be close to, revenue will be 1 million, 1.5 million. It will grow step by step, and to match, it takes 3 to 4 years to match the revenue between investment and what the annual subscription revenue start coming in. But when 5 customers become, so typically 5 to 7 customers at $1 million each will be good to suffice the subscription-based platform investment. So once we sign 5 to 7 customers, the platform could be break even. But then 7 to 20 customers my incremental investments in the platform are not more than 20%. It's vary between 10 to 20%. So my RPR, revenue per person who is deployed on the platform business, moves up substantially multiple times in the platform story. And platform story is the recurring revenue, which has got a next 10-year life cycle value, which revolves around the platform. So that is the 6 platform story versus 10 product story. Product story. Now the next question comes to your mind is platform cannibalizing license revenue? Now for looking at it, we found that there are certain markets which are suitable, certain products and certain markets are suitable for platform, and certain markets are suitable for license, and certain kind of customers are suitable for license. So tier 1 customers are suitable for license, while tier 2, tier 3 customers are for platforms. Similarly, certain markets behavior is they want to buy license. So if you intersect this, the platform will be country specific and focused customer specific. When I'm looking qualitative of the markets, I visited, spent some time in US market. This was a concern as an investor you are highlighting. When is the US market traction will be start moving in? Now this year we have visibility that US will move 50% growth in the US market. US market, we have 2 platforms. One is Exponent, which is underwriting platform. We are working with close to 22 prospects in the US market led by IC. And similarly, we have an IGTB platform, which we are having a close to 24 prospect. We are working with IGTB on the second platform. So US market, our strategy of platform is now started getting traction, and that is giving us a confidence that in US market, which was going slow in first 5 years of our journey, where we kept on making a lot of investments in AI, machine learning, data, now it started paying off because the product that we have is one of the unique product in the market, and that platform gives magic submission, data and underwriting platform all integrated, and which can be implemented in less than 3 months time or onboard the customer in 3 months time using the AI machine learning cloud technology. So that's a similarly Canadian market. We invested the full kit investment in Canadian market, and that is started delivering results. Canada market has got all the Intellect suite product starting including treasury, even core banking products in Canadian market. So Canada is becoming a wholesome market for Intellect. In Europe, if I come to Europe, we discussed about Europe last time, that how the what is selling in Europe. Europe now looking, the new investments are coming in Europe now. First of all, the good news is that they are now looking for modernizing their old systems. A lot of legacy, which is 40-year-old legacy, they are looking to upgrade that, and they are upgrading with a very strong architectural mindset. So the difference in Europe and other part of the world is Europe, like German focused or French focused or UK focused, are focused on architecture. And because we are focused, Intellect products are designed for open finance, composable and contextual platform. And then we have the ability for microservices to be composed across core, lending and credit card. These two combination, one on domain combination of core, lending and credit card, and on other side, we have a data, AI, machine learning, cloud, microservices, cloud compliance. The number of prospects are increasing every day. Rajesh can take you to the journey, but his hands are full. His capacities are totally full there. He needs to add the capacity very quickly in that area, and especially after we got a reference, one of the reference client going live in Germany, with the open finance platform, first of its kind, which has gone live. While my competitor may say that they have open finance, but they may not have a reference site for going live. This funnel is moving better. In UAE, 7 out of 9 banks as our customer. Now we are expanding. Saudi market is growing very well. We have 5 customers in Saudi. So this year, so on Europe side, our focus will be Germany, setting up a more new operation in Germany and France. In Middle East, Saudi will be our expansion. Africa market is growing on the back of Quantum. Quantum is bringing leads from various unique country. Sometimes they are very fascinating country, where some of it sometimes I don't even know the name of those countries before getting RFP. So it means it's coming by the pull of the Quantum. They are approaching us and then we are going to those markets because we don't have those connections like Mauritania or Madagascar. We didn't have any connection. It came from that side. So there's a very good news that when products start getting the pooling effect. Similarly, all the product lines are operating in Africa market. APAC, we did a good job in last 5 years. We have 9 banks in Vietnam as a customer, 9 banks in Philippines are a customer, 7 banks in Malaysia, 4 in Indonesia. Now, this is a time when we need to start looking for deepening our relationship. So we shifted our office in Vietnam as a center, that how we can do the business impact from the implementations we are doing in Vietnam market, and how do we build more deepen the account kind of a model in APAC. In India, obviously, as you all know, our presence, we manage the national critical infrastructure, whether it's a RBI, whether it's a GEM or LIC or AMFI. 9 of the top 10 private banks are using our technologies. Sri Lanka, we have some presence, not getting impacted with the turmoil in Sri Lanka. Bangladesh, we have a Sonali Bank partnership. Now we are looking more entry into Bangladesh. So this is about market analysis. Where last time somebody wanted to have what is the market footprint. So instead of answering question individually, I try to put all the slides for all the markets in this time as a qualitative. The other thing which is happening on the product side, our data platform, AI and machine learning platform. Now we are start getting it in a monetization phase of it. So last 3 years it took to build this platform. So first platform which is there is Doc to API, where we have a contextual using CDR graph technology. We are able to add a lot of value in document reading. Our accuracy across pages, if you have 10 pages of document and you have to contextualize between first page and 7th page, our technologies can do it, which many other AI technologies are page by page technologies. It can read any context from any PDF document. Now we are using that technology to go to market. We use this technology for Magic Submission for underwriting platform. We are using the same platform for Magic Invoice, and we are using the same technology for iColumbus AI for LCs and guarantees document to be there. So Doc to API is underlying platform. So it is a one-time investment, but we are building in multiple use cases for looking at. Then our data platform now, we started spending some time on that go-to-market of data platform. We found that our MQS research, multi-question search, is very unique search combined with big data and MongoDB and contextual AI algorithm. Now it's we are building for next quarter launch for complex risk requirement of large banks and insurance company in area of underwriting and risk. The third technology is what we are working on, the integrated banking platform, 300 TBCs, is creating a demand in the market, especially in Europe. Quantum, as you have mentioned, it's a consistent winner exponent. The platform is gaining momentum. I mentioned digital transaction banking is our core cash cow for us with Microsoft Azure partnership. Now we have started doing prospecting, name prospecting. With the increased interest rate scenario, liquidity management system is now getting a lot of RFP now, and Wealth Cube is moving from 3 buckets of the products, P1, P2, P3 buckets. It's moving from P3 bucket to P2 bucket, and IDC is moving from P2 bucket to P1 bucket. So that's how this transition is happening. Rest of the slide is you can go through how the analyst readings are there, which is each analyst is covering our product. So Intellect is now in the top 3 players in core banking between Thought Machine, Caminos, and Intellect. Many RFPs we are getting qualified in that area. We need to increase the capacity for pre-sales and partnerships. So these are the 2 things which is our core agenda now. Thank you very much.
Thank you, Arun. Now the platform is open for the questions. Please click on raise your hand. Please click on raise your hand to ask your question. The first question is coming up from Mr. Mohit Jain of Anand Rathi Securities. Mohit, you can ask your question. Please unmute him.
Okay, sir. One was this QOQ drop in SaaS revenues. So what happened there? And if you could give us some split on if it is pure SaaS license or is it SaaS license plus SaaS implementation?
What is the drop? There's no drop in SaaS, no?
Sir, in dollar terms, it appears there's a drop on a sequential basis.
Quarter 4 to quarter 1, okay?
Q4 to Q1.
Q4 to Q1.
While we were thinking SaaS should not have any seasonal fluctuations.
No. In transaction-based, that's why I classify 2 platforms. One is a transaction-based platform. There will be fluctuation in a transaction-based platform. While the annual subscription-based platform, there will not be dip. So
we are looking at this 1160. This is total, is it?
Last quarter, how much was it? 119. Yeah. So there was a
119. That is right. That is correct.
Yeah. So that was marginal dip in GEM revenue. The GEM is a quarter 4. You have a higher volume.
Okay. So that was one. Now, second was on your margin outlook. Now, what you have spoken about is there could be a 3% point drop rate in R&D and other things. While if you look at it from a YOY perspective, there is already a 3 percentage point drop. So what we are referring to is from Q1 margins, we may decline, or is it the comment is more related to Q1 23 versus Q1 22?
Yeah, Q1 23 versus 22. So we are reinvesting our margin for platform a new learning. So our margins will be in the bracket of 20 to 25% bracket, not 25 to 30% bracket, which we were earlier targeting.
22 to 25, sir. That's a steep drop actually, from 25 to 30.
25 to 30 to 20 to 25. No? With a 5% we are reinvesting. We are investing margin investment. We are doing. We are not raising any capital for the platform journey.
So that was second. And third, I think you used to give us this capitalized amount, which is missing in this quarter's presentation.
Capitalized amount is mentioned. 35 crore is mentioned in a. It's not there in presentation. Maybe we'll just look at 35 crore. Is
35 crores for the quarters.
Yeah.
So your capitalized amount has also gone up by the same quantum in that proportion.
All the 3 investment I mentioned, the platform has a R&D investment. So capitalized investment. So we capitalize only. So if we have 6 platform, our investments are close to between $25 to $30 million plus product investment. So total investment, we are only capitalizing less than $20 million investments. So total capitalization investment, when we are saying from the beginning, is around $20 million. Now it's around, it will be around 140 crore around capitalization for this year. This was mentioned in an earlier call also. So, but not the exact number was not given because that time we didn't have the budget approved. Now the budget approval of the capitalization is through. So around 140 crore, which is around at current currency rate, it will be close to and 18 to 19 million dollars.
Sir, this amount is largely in INR, is that correct? Or will it fluctuate depending on the exchange rate?
Exchange rate also, there are people in international product managers are sitting in UK or in US.
Okay. Next was on the ARR. While I heard your comment, I was not sure what is included in ARR, which you have disclosed. So if you could just help me understand that part.
ARR is, which is annual recurring revenue, which consists of platform. We say B2 platform, which is a annual subscription revenue. B3, which is a transaction subscription, plus AMC.
So platform subscription plus platform transaction plus AMC.
That's right.
Implementation revenues are not included in this.
That's right.
And you multiply that with 4 to give us a picture on the annual basis.
That's right.
Perfect, sir.
And we
last
are
one.
giving LTM. We are giving LTM now. We are not even giving forecast number. We're not multiplying it. We are reverse. Now we are giving a more accurate picture of LTM because now LTM is available.
So the number that you have given on slide 11 is LTM number, not annualized, not quarterly annualized.
Not a quarterly annualized. Because that time last year we were giving annualized, and that was a question raised by one of the investors that why won't you give LTM? That will give you the better picture.
Right. And so finally, US is looking up. From the currency breakup, it appears developed markets are finally coming through. So you have given this growth target, etc. Any percentage split, like how small or large are we in the US currently, from where you expect this 50% growth?
Not right.
Approximation will do, sir.
This is small right now, and I think it will go better. But the US is catching up, and company entering into US. Last time we said last year we were looking for Europe. So the story over here is calibration, curated, calibrated growth, country by country, product by product, country by. Now last time you had Mohit, you had a question on US, what is happening on US, and I didn't have a response.
For last many quarters I had that question, but yeah, good to see finally you guys are moving there.
And if I didn't have an answer, I didn't want to tell you anything wrong on any hopes of that nature. I told you we didn't have a time, we are working on it. So right. Now the results are there, now the visibility is clear, I can speak to you.
No, perfect, sir. So FY23, hopefully we'll see more growth in US. And last was our gross margin, right, which is a linked question. But when we improve our growth rates in the US, should we expect gross margins to improve during the year?
Not this year. 24, you will see significant improvement. This year, I think platform investments are higher. We have to invest upfront on the cloud. We have to invest upfront on POCs. So those investment goes up in a cloud platform business.
Sir, I was referring to growth adjusted for R&D, excluding R&D investments.
But some improvement will be there in gross, but still POC investments, sometimes it goes into delivery investment. If you book the POC all into sales and marketing, then there will be gross margin improvement. So I'll just
the current norm is fine, sir. We are used to having this time.
Okay.
All right, sir. Thank you very much, and all the best.
Thanks, Mohit. Next, we have Mr. Vivek Charoria. Please unmute him. Vivek, please ask the question.
Hi, sir. Thank you for the opportunity. So this quarter, we saw a sharp jump in the pre-EBITDA cost from about 390 crores to 425. Do you think a bulk of the jump is behind us, or should we expect a similar quantum? I'm guessing as you move from 70 to say $80-85 million, how much would the cost go up for every, say, 10% growth in revenue?
Our growth, the numbers, cost numbers goes in lumps, $15 million bracket. So our cost with the opportunity available, our cost will go up in Q2. It's not the end of the cost increase which you are seeing. It will be Q2 also will be the higher increase. The new fresh intake is also there. Headcount also we are planning for the $90 million number. So this quarter will have an increase. Q3, Q4 will be more salary increase, flatter increase. But yes, travel increase will not happen in this next quarter. Travel increase of pre-COVID level now come to the almost 80% level in Q1. 20% differential will happen in Q2. So these are two places the Q2 cost will increase. But new headcount cost in Q2 will go up.
So this new headcount cost, is it in preparation for the 90 million? What I'm trying to understand is, so I'm guessing we'll be in the investment phase for another quarter or two. Would that prepare us for a 90 million run rate? Or, I mean, every quarter we... Okay, so say by Q3, our cost structure should be aligned to 90 million. I'm just trying to understand when the operating leverage can play out.
Exactly. Now, if you play last year, also Q2 cost, we went up by some, I don't remember the number, but there was when I had a call on October, the number went up. So Q2, Q3 number went up, 2 quarters number went up on the salary cost. That was the time when we were preparing from $55 million to $75 million. So that $15 million jump has seen in this quarter. So in 3 quarters later, you've seen the jump. And that number got accommodated, and my EBITDA margin is around 21.6% this time. Though 3% is a drop compared to 25%, which is normally in the industry which happen, which is the talent cost increase and the travel cost increase. So now whatever we do in Q1, Q2 cost increase will service us for the next $90 million run rate.
Sir, any color on the top line growth? Are we seeing any headwinds in Europe or other parts? And what is the 2 to 3 year outlook? If, I mean, are we still hoping to hit 100 million run rate in the next 8 to 10, 12 quarters? I mean, some color, and how confident are you of achieving that? Or is it only a case where we need to just increase the capacity to service the demand?
Demand is there, healthy demand is there, Vivek. Market is looking for buy versus build. Quarter on quarter, the way we saw last quarter, 1 or 2 deals here and there, Ukraine deal, 2 deals. So because of Russia, we dropped on it. Otherwise, we are seeing a positive traction right now in Europe and America. So now I have given the commentary, country by country commentary. So I'm not even given a general commentary of advanced market. So based on that, I think you can make it out on that $100 million quarter on quarter. I think all of us are looking for 8 to 12 quarters to get into $100 million per quarter. So that trajectory we are working on. Manish, me, Rajesh, Banesh, all of us are working. Beauty is now third business of Banesh also is started delivering substantial results. So after last quarter, so if you look at it, in 2019 we spoke that GTB is now got $100 million. Then we said GCB will now work for next 2 years. Now then GCB started giving significant result. Now it's a time when Seek, which is a third business, started delivering results from this quarter onwards with exponent, underwriting, AI, machine learning strategy. So 3 out of 4 businesses we look at it have started giving substantial throughput. Now we have to spend time in the RTM, but it's going as per the very calibrated structure.
So just one last question. So just trying to understand this once again. So while we're in the investment phase, our margins will be depressed, as you said, in the 21 to 22 to 25% band. But when we're at 100 million run rate in the next 2 to 3 years, I'm guessing the margin should be much higher than that, or would that be wrong to assume?
Should be again. At $100 million level, it should come back to 30%, 35%. At $100 million level.
So that still stands, correct?
Yeah.
Okay. Thank you so much.
Thanks, Vivek. Next, we have Mr. Ankush Agarwal from Search Capital. Ankush?
Yeah. Hi, Arun. So thank you for taking my question, and congrats on a great set of top line growth. So firstly, what I want to understand over here is that when you say that you will be reinvesting 4 to 5% margin to support platform revenue growth, So can you talk a little bit more over here? Like, where is this investment going? Is it going on the sales and marketing front, or is it going in the product R&D? And for how long you expect this to continue?
Ankush, you can just understand when any platform is created, like Naukri.com gets created, or you take easytravel.com that gets created. When you create a platform, initially you put up a full kit team. You will put up a few architects for there, few designers for it. So it's first is, then you put up a full go-to-market team, marketing team. So the money goes in all the 6 dimensions of a business, from brand to end customer to leadership to IP to execution and finance capital. So all the 6 capital, which we call belief as a framework, all the 6 areas the investment goes in. So that investment in a platform, as I explained, it's cost $5 million typically for a platform on an annualized basis. Initially, the revenue may be $500,000 to $1 million in first 2 years or 2 years.
Right.
And when it crosses $5 million with 7-8 customers, then we can shoot it up.
Right.
Okay.
So, then if we are saying that we are now investing in these products and these are gonna add to the top line, so would you be saying that our outlook for revenue growth, which was earlier at high teens to about 20%, that would increase substantially since we are now investing in additional platform?
If we are able to do in a product company, so Ankush, one point is product company 20% growth is equivalent to 30% growth of service company, because
Right.
I have tail revenue and
Right.
sustain.
That is
So-
fine. That is taken. What I was asking is, earlier we had this framework, that high teens to 20% growth, and then you had this margin outlook of growing to 30%. But now, since we're investing more into additional platforms, so shouldn't that add more revenues and then increase our top line outlook? Because now you're investing more.
Ankush, I stayed there. Like in LTM, we have 29% growth in LTM, but I still calibrated the business at 20%. So we may get higher number, but we still say 20% is the calibration of the business.
Right. Okay. So with this 20% growth that you're not saying, and with the additional investments, so would profitability will at least grow, at that rate, or it would be much lower than that? Because earlier we were guiding, X growth in top line and then, relatively higher growth on the bottom line front because of the margin expansions and all that stuff. But now since we're investing more, would it, the higher growth obviously is not going to come because now investing 4-5%, but would it be much lower, or would it be like at least still what the top line is growing?
The margin will grow higher than the top line. In this quarter, it was change of the quarter. So this quarter number should not be reference number, because this quarter.
No, I'm not saying about this quarter. I'm taking it from the comment that you're going to invest 4-5% of the revenue. So that would obviously, and that is going to be continued to a couple of quarters at least. So since, say, for example, last year, FY22, I think we did about 20% EBITDA margin, and if we're going to invest 4-5% more, so that would put a lot of pressure, obviously, right?
No, Ankush, if you've seen last year, you look at the numbers, it moved from 20% EBITDA to 27-28% EBITDA. So there is the operating leverage play also happens. So 4-5% when we are investing back,
Right.
that operating leverage lever between the top line and bottom line as a product company will always have that advantage. Today, the talent cost, which has gone up in the industry, but once it's cooling down, that impact will not be so much in 23-24. So margin will improve going forward, and it will be going faster, higher than the top line growth.
Yes, sir. Got it. So basically, you're saying that even though you're making this much investment, but there is an element of operating leverage, and that would cushion some of this 4-5% cost increase, right? Yeah. So lastly, just on the use of cash. So now we have more than 500 crores, and obviously we had allocated some 100 crores to the AIF investment, but that is gonna be in the future and will be more piece by piece. So any thought on how we're gonna use this cash? Because historically we have mentioned that we are not so much interested into inorganic growth. So and we are still going to generate a lot of cash this year as well. So any thoughts on that?
Still the amount of cash is just sufficient. It's a 1 quarter cash. We have 541 crore revenue, 558 crore. I think as a product company, we need this much cash as a bucket to reserve. We'll talk about it when we cross 1,000 crore cash.
Okay, so you want to keep some 500-600 crores cash is what you're saying.
That's right.
Okay. I'll get back in the people for the question. Thank you.
Thanks, Ankush. Next, we have Mr. Moez Chandani from Centrum Broking. Moez?
Yeah, hi, good evening, sir. So my question was on the employee benefits and on employee attrition. So are you seeing a decline in the employee attrition, both on the senior level as well as the junior level? That's one. And secondly, are you also, I think you mentioned that you're going to hire a lot more people this year. So can you just give us an idea of how much is the hiring expected to be this year as opposed to what it was last year?
Okay, so the three questions you asked. First is attrition level. Yes, we are seeing the pattern. It's dropping since May onwards. Because the startup issue started happening. It's dropping now. Attrition is dropping. Our attrition is, second question you asked about senior level attrition for us is less than 10% from last year. We didn't have a senior or mid-level attrition. I think we have a very strong culture to retain there. That's not a concern. Last year also our attrition was in the bucket of 2 to 5 year bucket. That is because we may not provide them the global opportunity of going to send them to on body shopping assignment. So that's the area where we now refilling back with a strong module of fresh engineers and creating a fintech engineer program for them. So that's attrition. Exact numbers for this year, how much we need to recruit. I think that plan is very as of now not fully worked out. It will be between last year. I think we would have done 800, 900. So this year will be similar number maybe there. I think we need to work it out with the platform right now, platform strategy. So I'll come back. As of now, we are not formed up. We'll take some time to form up, maybe another 1 or 2 months formed up.
Sure. Thank you for that, sir. And when are the salary increases being rolled out? If you can just remind us.
In our case, it's almost the major load of salary increase happen in first quarter and second quarter, but it's a quarterly cycle. So we don't have a one single cycle. We have a rotation cycle.
Sure. And the salary increases that are being rolled out this year are in line with what was last year, or are we doing better in terms of salary increases this year?
This year is higher than the last year.
Higher than last year. All right, sure. Thank you so much.
Thanks, Moez. Next, we have Mr. Aman Thadani from Solidarity. Please unmute him. Aman, ask your question.
Hello,
Aman?
can you hear me?
Yes.
Thank you for taking my question. Sir, my first question is, can you help us understand the target addressable market basis the products that we have in each business division?
Yeah, so when I look at the market, I told you about each product. So I took you to the 5 market presentation deck and look at it, which products are relevant in which market. So if you just go back to the presentation, I think I don't have to repeat the same.
Of each market or for each product, that how much can we do for our transaction business, or how much can we do for our core banking business, or what's the size that would be of that each market?
Yeah, we are not announcing the how much revenue per product per market. So that's what we don't announce. It's the overall number we can announce. We don't want to do that for our competition. So we don't announce those numbers. In a, yeah.
So my second question is, so did banks replace their existing software with ours, or did Intellect make something new, which is like an add-on software?
Can you be a little louder?
So, did banks replace their existing software with Intellect, or did Intellect make something new, which is an add-on software to a bank?
Not able to get you, Aman. Aman, we are not able to hear you.
Can you hear me now, sir? Hello.
Just repeat.
Sir, the products that we offer to banks, so did banks replace their existing software with ours, or did we make an add-on software which they're using above the legacy software?
They do both the things. Some of the time when we do a complete digital transformation, we replace the existing banking product. And then we do a specific platform. They act as a periphery solution and they coexist with the existing solution. So both the things are there, Raman.
So can you help us break this down? Like what proportion of our revenue would be we are replacing someone, and what proportion it would be that we are offering something completely new?
How will it help here? I also don't track it. How will it help you to forecast? So I think we don't do an over analysis of the numbers. So
Okay. So that is it from my side. Thank you, sir.
okay. Thank you, Aman.
Thank you, Aman. Next, we have Mr. Mayank Babla from Dalal Barocha. Mayank.
Thank you for taking my question. Sir, I just in the early part of the call, I missed your commentary on you're going to, spend this year for this products and R&D. So what was the amount that will be routed through P&L and what would be capitalized? Could you just elaborate on that?
Yeah, typically, if you look at 6 platforms and $5 million, $30 million, between $25, $30 million, we expect the investment in all the buckets. So, but we are capitalizing only a small piece of it. As our capitalization amount is remaining less than $20 million, it will be close to 18.5 or 140 crore will be the investment in the capitalized amount. Rest of the amount is expensed out, whether in sales and marketing or expensed out in R&D or software development expenses. All the 3 heads it will get expensed out. So almost 70% amount is expensed out, and 30% amount is capitalized.
Okay, sir, got it. That's all from my side, and best of luck, sir. Thank you.
Thank you, sir. Prabal, you want to just summarize?
Sure. Yes, of course. See, there are a couple of things. I think we have discussed a lot of numbers and questions from investors. I think there are just few points which I would like to leave you with. In a quarter like this, which is actually quite a pivotal quarter in many ways. Very similar to 2 years ago in July 2020 when we started on a new journey, and the results are something which are there for you to see. So this is also pivotal in that sense. And I think Arun has spoken a lot about the crux of this quarter, which is journey from product to platforms. I mean, that is fairly fundamental in this entire journey of from product stack to products to platforms to ecosystems. In that entire journey, this phase which we are highlighting today is actually very fundamental. And the important thing for all of us to understand and appreciate is that the company, as we have disclosed earlier, is built on 4 fundamental pivots, and we continue to remain on these guiding principles and foundational blocks, so to say. And I'll just highlight those 4 in a moment so that we all have common understanding. The 4 fundamental pivots are: 1, that we are an IP-led company. And monetization of IP through new and innovative business models is something which is the core DNA of this organization. And that is what creates value. Right? And being a young company, of course, our priority remains to populate the market with our IPs. So far, it has been products. Now it will be products and platforms. So this is the fundamental of an IP-led business. The second important pivot is that we will continue on a path of calibrated growth with predictable profitability. So we will grow, but we'll grow in a calibrated manner in selected markets, in our chosen accounts, and so on and so forth, and with a predictable profitability. Right? The third one is that our growth with respect to competition will always be market leading. So we don't want to give numbers of 25%, 30%, 20%, all of that. We have said that the organization is geared up for a 20% type of growth, but it will be market leading depending on where the markets are. The world is not in a good place, as all of you know. So therefore, but we will be market leading with respect to our competition. And this growth will require continuous investment in the IP and in the business to keep the technology contemporary and ahead of the curve. Right? And we talked about this in length in the technology day. And I think this is the third important pivot, that there'll be market leading growth, and that growth will require continuous investment in our IP. Right? And the fourth important pivot, very important pivot, is that this growth and investment will not be capital dilutive. So efficient capital allocation will be the cornerstone of our growth strategy, which we mentioned earlier, and we continue to do that. So there'll be no capital dilution. Now, the moment you put all these four in a bucket in terms of a strategy, it becomes obvious that to secure our future in terms of the new opportunities which are coming in the marketplace, in the current context, it is platforms. The investments for that will necessarily have to come from the existing cash flows. And that is the point which Arun was making, that the trajectory which we have talked of EBITDA so far of 25 to 30%, that trajectory will get compromised because we will use about 4 to 5% of that and put it into the bucket of investments. So now it will be 22 to 25% of their efforts. That is the crux of this entire thing. So as long as we sort of appreciate this fundamental precept, we will know that the company is actually going to create the institution which we have always talked about. We are on a certain path which we have chosen for ourselves, and it's all about the choices we make. Now, we see massive opportunities in the platform play. I think Arun mentioned that, and which is really an extension of the solutions to ecosystem play which we had outlined. So therefore, this current state, what it does for us, just to give you a benchmark, is what it did for iFlex in 2008, 2009. Since then, the iFlex has not grown significantly. If you have seen, they have not grown at all in many, many years. But look at their cash flows, their margins. It all is a result of that phase of iFlex from 2007 to 2009. And I dare say that, we being a young company, we are actually creating revenues and avenues for future flows from these platforms. And most importantly, it does not cannibalize the existing revenue streams. Because the large banks, as Arun mentioned, tier 1 banks will continue to the usual license route and all of that. So we are creating new opportunities for avenues growth by monetizing our IP. I think this is a very, very fundamental shift and of fundamental importance to understand. And so therefore, financials you have seen both Y on Y as well as LTMs, we have been healthy on practically all parameters. The pipelines speak for themselves. I think $600 million to $800 million in 1 year is saying a lot. And the average deal size, of course, has gone up and all of that. So therefore, I think we are by and large on the chosen path within the choices we have made, and sort of sticking to the path of making a sustainable business which will have value creation at the end of it. Yeah.
Thank you.
Thanks, Prabhu.
Manish,
Ar-
Manish, you want any speaker? Yeah,
yeah,
Parveen?
Arun, we have a couple of more questions.
Okay.
So
Quickly,
can we have?
Yeah, just
Can we
one
have
or
Arun?
two questions we can have.
Yeah, sure.
Okay, Mr. Rohit Balakrishnan from iThought.
Yes, hi.
Hello, sir, am I audible?
Yes,
Yeah,
yes,
Rohit.
Please go ahead.
Thank you for the very detailed presentation, Mr. Jain, very helpful. Sir, I just had, probably it was sort of answered, but just a couple of clarifications. So one was the path, the glide path that you explained, maybe towards the margins. Is it, so to understand this, is it the right way that probably from H2 FY23 or probably Q4 FY23, the margins will be back to what they were, let's say, I mean, to the earlier guided range, and from there on, the margins will sort of see an expanded path, as you explained that whatever platform led, I mean, platform revenue that will take. Is that the right way to think about it?
Yes, absolutely. So the way to think about it is see the choice which we had now. Let's just step back for a moment. The choice which we had now is because of this emerging platform play, which is sort of showing a lot of traction. If we did not invest properly in this area, we could have still remained at 25-26% margin very easily, right? But that is not the wise thing to do. So therefore, we are creating avenues for future growth. Apart from product license remains. I mean, that is something which will remain, but these are creating different avenues with the same IP. And that is the beauty of an IP-led model at the end of it. But obviously there'll be a glide path, and there'll be a, just that's why I gave the example of iFlex, 2008, right. 2009, and look at it today. I mean, no, and yet cash flows, right? So being a young company like ourselves, our priority is obviously to populate the market with as many products and platforms as we can in the next few years. So the ultimate objective and the ultimate sort of goal at the end of all this would be when we reach a certain mature phase, we'll have enough populated products and platforms in the market which will give those cash flows. Yes, absolutely. But whether it's 1 year or whether it's 1.5 years or 2 years, that's a moot point depending on how. Because you see, today we are faced with two things. The entire industry is faced with cost increases. We all know that. Plus, we are opening up after COVID. That also we know. Plus, we have this platform opportunity. So all three are coming together, and that is the reason you see this, this minor recalibration of the EBITDA path, which we have talked about. So, yeah.
Sure. No, very well explained, sir. Again, thank you very much. And so the second question was, now the subscription, or now what we call this platform, is about 116 crores this quarter. So one question that I had was, we don't disclose GEM, how much it is, but I'm assuming that GEM will probably come from contract renewal. So just qualitatively, can you share, like, what is there any risk on that part for it to sort of, and I mean, I don't know how much you can share in terms of how much quantity, in terms of quantum it is there, but as an investor, I just wanted to get that part understood from you, from a risk point of view, let's say somewhere in FY24. If my understanding is right, that revenue is going to come for, the contract is coming for renewal.
Would I like to just answer?
Yeah. GEM revenue is asking about GEM revenue. Unfortunately, we don't announce it, and it's not right in a confidential with the government. So unfortunately, what Rohit is asking, we cannot answer right now.
Okay.
So just if I can sort of, I understand, sir. I mean, but if you can give some qualitative commentary, in the sense that my context of the question is that. Hello.
It's difficult to them to build it up anywhere, Rohit. These platforms, once you design, the chances of extension are higher, substantially higher when the TC has got a passport office. So, so unfortunately, I cannot disclose it. So leave it at that, Rohit.
Okay, sure. All the very best, sir. Thank you very much.
Thanks, Rohit. Next, we have Mr. Rahul Jain from Daulat. Rahul, please ask your question. Rahul, you're there?
Yeah, can you hear me?
Yeah, Rahul, please go on.
Yeah. Thanks for the opportunity. Just wanted to understand, and sorry to harp on the question which has been asked earlier. The need for the investment on the platform side, is it also led by the evolving demand in the market, and where some of our past the power and the prowess to win of our existing product may not be as sharp as we may need to, and that's why there is this sudden need for investment, or this you think is a logical investment which any R&D company has to do as part of the business equation?
Rahul, how many companies have entered into US market with the platform from India or even Europe? It's very difficult to enter into US platform coming from India or Europe companies also on a big organic basis, not inorganic and acquired. The Temenos acquired the company. These investments are required to have a big opportunity in Europe and America to leverage using platform and building a recurring revenue stream. It's such a big opportunity your company has built up. Rajesh has built up, Manish has built up, which is need to be supported by the, and this is getting supported from the margin redeployment, not by capital generation. A 4% margin redeployment is a very normal for any business decision from a board level.
Right. And just to extend the thought, in terms of as you said, the kind of a product which is relevant for that market. So if you could share your thought on how the current product would compete with the likes of a product that we see new age product like Mambu or maybe Thought Machine, or you would say that this kind of development is just a small.
Rajesh, will you take up this question? Yeah? Competition with the Thought Machine, Mambu, and Temenos.
Sure. I think before answering that question, I've been listening to this conversation. Let me give you a little bit of business commentary, especially looked from a retail banking or a core banking perspective. I think the way we are looking at the market is really, if you look at our products, right? We have 3 products. Quantum, we talked about it, right? It's a very specialized product that we built for central banks on the back of our win on RBI, right? And in the last 4 quarters, we have won 10 deals on Quantum, right? So that's the kind of momentum we are seeing, and that's the kind of momentum when we say that Arun talked about the pull being generated. Today, we are called for opportunities, right? Where we don't have to go and sales, we are getting pulled in by that demand that we have created from a product perspective. So that's about Quantum. It's a leadership product. It's going from strength to strength. We have made a lot of progress in Africa, Middle East. We recently won, I think it's in the news, the Saudi Crown Prince has talked about this new country. So we are seeing a phenomenal momentum in Quantum. We are now seeing some growth in Quantum even in advanced markets. So in the coming quarters, hopefully we will be able to take Quantum to even advanced markets. So that's on our first product, which is Quantum. The second product, which Arun talked about, which is moving from phase 2 to phase 1, is our core banking product. And you saw in the list of deals won, we won 4 deals last quarter on the core banking as a product. That's again, if you compare, if you go and look at what Temenos is winning or Oracle is winning, we are in the same league from a number of wins perspective. We are also seeing momentum on lending. You saw 4 more deals were announced where we won on lending. So from a product perspective, we have a very clear strategy. We are focused on quantum. We want to take it all. IDC is on a hyper growth trajectory now, and lending we want to take. Now let's talk about platform. So what we have done is we have, from a retail banking perspective, we have 2 platforms. One is, of course, our iCredit 360 platform, which is typically targeted towards Europe. And we have an open finance platform, which is again targeted in Europe. This is a platform which Arun talked about, which has the breadth of core lending and cards. We are in a unique position to offer that. And what we are seeing in the market is that many European banks, regional banks, as well as large banks are looking at modernizing their platform. So we see we are in a good position in that. And if we specifically talk about Europe, we are in the large 5 deals. We are in the last 3. And guess who are our competitors in all these 5 deals, right? It is Temenos, it's Intellect, and it's Thought Machine. So we are now in the same category as a Temenos and a Thought Machine, where Temenos brings the functional depth, it brings the brand name, it brings a lot of references. Thought Machine is building a cloud native architecture. What we are bringing is the width and the depth, as well as the latest architecture. So I think many of these deals, we are seeing a lot of competition happening between us, Temenos, and Thought Machine. Some of the deals, Thought Machine may be ahead, some of the deals we are ahead, some of the deals Temenos may be ahead. But it's a neck-to-neck fight in many of these deals in Europe that we are seeing. So I think that's what I would like to say. If you look back and see Temenos Capital Day presentation, you will see that even Temenos has recognized us as the second, as coming closest to them from a winning deals perspective. So I think that's where this platform story, the open finance platform story of Europe and the iCredit 360 platform is fitting in. Good momentum in the European market is what we are seeing, both in UK as well as continental Europe.
Right.
Okay.
So, yeah, appreciated the color, and sorry if I can possibly ask one more. So just to sum up the entire thought process, what I essentially found is that we are getting into newer market, we are getting better acceptance in the market for our offering. We are coming up with new offerings which also expand our market scope and positioning. And then we are also getting a lot of proactive deals because of the kind of offering we have. Now, when we have this kind of accelerated thought process in terms of the revenue potential, and we are also investing more and more in the business, somehow the margin commentary is very, very clear, which is getting aligned with this kind of an thought that you have, but somehow the growth commentary is not reciprocating the same enthusiasm. I think somebody else also asked about this, but is it somewhere like the real advantage of all this exercise may come much later than in the recent year, and that's why you are trying to not give that kind of a view right now, or this is more about being conservative in Gen Z?
Whatever you interpret, Rahul, that's okay. But we are saying our LTM is 29%. We are saying calibrated growth. We have designed the organization for 20% growth. We don't give a guidance. So we told guidance we stopped giving. But we are saying how the business is designed, and we are sharing with the design principles which Parval has shared and I am sharing. What interpretation you want to have it, it's your call as an analyst, what you want to look at it. But 29% growth we have demonstrated in last LTM. So commentary can be better. It will be good for the investor, but there's no point of looking at it. My competitors are not growing more than 5%, 7% single digit growth. in my entire product journey. If I'm growing 20%, I'm very, very happy. And if it's 25, 26, 27% happening, lucky to have everybody on the same page. And we have many strategic deals on the table. We have 15 strategic deals on the table. Each deal is more than $10 million deal. It can change the color of the growth differently. But there's no point of till the time we win this. 15 deals of the nature, which are now getting us into $10 million to $100 million range. So we are fighting in many deals, which is more than $50 million. After RBI deal win, we are now getting to $50 million, $100 million deal fights with Temenos and with Thought Machine. So we are very enthused, but specific number to put it, I think you don't want to put. We said, what is my design principle? Design principle is 20%, and the rest of it is the interpretation, what we succeed.
Sure. Thanks a lot. That's quite encouraging. Thank you.
Thank you.
Thanks, Rahul.
Yeah, that's.
Can we take a couple of more questions?
This is already 6:30. Now we can just take the question by writing.
Okay.
Unless somebody,
So one last question we can take at least.
No, just last question you can take.
Yeah. The last question, Ashish Das from Sharekhan. Ashish, can you quickly ask your question?
Hi, sir. Am I audible?
Yeah, please go ahead.
So thanks for giving opportunity. Two questions. Yeah, I understand you stopped giving the revenue growth guidance, but at the starting of FY23, you mentioned 20%, but now you stopped the guidance. Okay, what is that reason? And second, last quarter, when you commentary, you mentioned that you are entering into 3 new markets and you want $10 million per country in next 3 years. Now you entered into the US. So is that commentary, is that outlook still remains?
Yeah, that's right. It's the same outlook. 3 countries: Vietnam, Saudi, and France, and now we're looking at Germany. So that commentary remains. So the guidance, we never given a guidance. We always said design the business for calibrated growth. Great. But it's understood as a guidance, so which is okay. Its understanding is there. That's what we design the business, because there could be ups and downs in license revenue. Sometimes we can win a very large deal, and other quarter we may not win a large deal. So it's not quarterly. Then we are looking at LTM as a growth chart. In LTM, we are able to ensure that it will be 20% design. Okay.
Right, sir. Yeah,
sir.
Yeah. Okay, sir. Thank you so much.
Thanks, Ashish. So since we have many questions, we request everybody to please do write to us any questions which we might not be able to take because of the shortage of time. And thank you all of you for attending the call. Thank you so much. Now we can close the call. And thanks everybody.
Thank you.
Thank you.